Hello, it's ChewDog Charts. Recently, a lot of people have been asking the question, when is the stock market going to collapse? Well, according to several economists and investors, the warning of a stock market crash is now. According to Jim Rogers, who founded the Quantum Fund with George Soros, he said a 68 trillion biblical collapse is poised to wipe out millions of Americans. Dr. Mark Faber, or Dr. Doom, recently stated that investors are on the Titanic and stocks are about to endure a gut-wrenching drop that would rival the greatest crashes in stock market history. As well, Andrew Smithers warns U.S. stocks are now about 80% overvalued. Smithers backs up his prediction using a ratio which proves that the only times in history stocks were riskier was 1929 and 1999. We know what happened after those periods. Stocks fell by 89% and 50% respectively. Even the Royal Bank of Scotland says the markets are flashing stress alerts like in 2008. They told their clients to sell everything because in a crowded hall, the exit doors are small. Even blue chip stocks like Apple, Microsoft, and IBM will plunge. Well, let's take a look. I have a series of charts to go through here with you. These are some of my favorite indicators. The New York Stock Exchange publishes end of month data for margin debt on the NYX data website, where it goes back to 1959. Examining the information, you can see the relationship between margin debt and the market, in this case using the S&P 500. This first chart here shows the margin debt and the S&P 500 in real terms. It's adjusted for inflation to today's dollars using the Consumer Price Index. At the beginning of 1995, you can see that we were well into the so-called boomer bull market that began in 1982 and was approaching the start of the tech bubble that basically shaped investor sentiment during the second half of the decade. The surge in margin leverage in late 1999 peaked in March of 2000, and you can see that here at this point, the red line being the New York margin debt, the NYSE margin debt, and the blue line being the S&P 500. So again, the margin leverage peaked in March 2000, while the S&P hit its highest monthly close for that year 5 months later at this point. So again here we have the peak in the margin debt, which preceded the peak in the S&P 500. So a similar surge began in 2006, peaking in 2007. Again, the surge in the margin debt peaked here in early 2007, whereas the S&P 500 peaked several months later at this point. So this is one of the things that I'm going to be looking at, is to see when we peak here in 2017 or in 2018. I'm thinking that the peak is going to come within the next, say, 6 to 12 months. We'll monitor this on a continual basis, so you will know. Let's take a look at the next chart. The next chart shows the percentage growth of the two data series from the same 1995 starting date. Again, using real data, which was inflation adjusted. Markers were added to show the precise monthly values. Again, margin debt grew at a rate comparable to the market from late 1995 to late summer of 2000 before soaring. The two data series synchronized in their rate of contraction in early 2001, but the recovery after the tech crash, margin debt gradually returned to the high growth in the second half of the 1990s instead of the more restrained growth that the S&P 500 showed. But by September of 2006, margin again went parabolic. Finally peaked in the summer of 2007, about 3 months before the market. After the market low of 2009, margin debt again went on a tear until the contraction in late spring of 2010. Even with QE now history, margin debt has reached another record high. The S&P 500 has also logged over 20 record closes since the presidential election. For reference, last summer saw 10 record closes, and in November of 2014 there were 12, and we are again at record highs. This last chart is the New York Stock Exchange investor credit and compared with the S&P 500 monthly closes. Basically, credit balance is calculated as the sum of free credit cash accounts and credit balances in margin accounts minus margin debt based on the nominal data, and again not adjusted for inflation. Taking a look, this is just another way of showing information that we've seen in the two previous charts. Shows that we are near record levels on our negative credit balance, record highs on the S&P 500. So for you as an investor, it seems to me that the margin information is a leading indicator, but one has to remember that this data is a month old. Although these are October charts, the latest information from the New York Stock Exchange is as of September 2017. So although this is a leading indicator, or can very well be a leading indicator, there is that 1 month lag. So in my opinion, I like to take a look at this and follow this, as even with the monthly lag, you can see that in previous peaks, it did, at least the margin data did precede the market highs by several months. So for now, that's ChewDog charts. Thank you.